Well, certainly, I mean, one of the advantages of Bitcoin is that it has this pretty long history now of going up over time, and so it can be quite volatile. And so in developed countries, a lot of people don't get why someone would own Bitcoin other than speculation, and it's because they're used to having pretty stable currencies. Whereas emerging markets, they generally, some of them are currently going through very bad periods of inflation, and other ones generally still have inflation somewhere in their memory over the past 20 years or so. Whereas the United States, we have to pretty much go back to the 70s to have a memory of strong inflation. And so in a lot of those markets, it's in some ways, I think it's an easier selling point of why they might want to hold something that's not their own government currency, that can't be debased in any sort of reasonable way or easy way, and that they are owning something that's scarce. And then, of course, some countries have capital controls. Bitcoin makes those more difficult to enforce. And so it means different things to different countries. And obviously in say, Lebanon, right, they have a much worse inflation problem than many other countries. And so that's, it's a more extreme situation. But across the board, I mean, I think it's one of those things where Bitcoin can benefit, people in every country. But I think it just so happens that emerging markets, I think, can get the reasons for it maybe a little bit faster.
Do you think you could briefly explain what network effects are and how they're useful when researching not only Bitcoin, but other assets?
Yeah, so network effects are a phenomenon where the more people that use it, the more valuable the network gets exponentially, right? So if only 5 people in the world have phones, a phone is not a very useful invention. But if half the people in the world have phones, then suddenly it's one of the best inventions ever. And so basically the phone gets exponentially more useful the more people you can call with it. And so the same is true for email. The same is true for social networks, right? You wouldn't want to have a social network with almost no one on it. And so that's generally one of the strongest economic moats that a company or a protocol can have against competition, is the fact that they've already achieved network dominance. And so I could make, for example, I could hire a programmer. We make a copy of Facebook. It looks similar, but then I'd have almost no chance to get people to actually use my version of Facebook. There'd be no kind of flywheel to get that started, because it's a dead zone anyway. Even if I threw $1 billion at it, I could get probably a couple million people there, but they would quickly just go back to the real major social networks, as an example. And so that's true. Also, I've used the example of Wikipedia. Wikipedia, you can download the data. I could host it on my website, and it would kind of look like Wikipedia, but it wouldn't have the millions of links around the world pointing to it the same way the real Wikipedia does. That's the thing I can't replicate. That's the network effect. And I can't replicate the fact that there's so many users on Wikipedia updating it. I can't convince them to come update mine instead. And so mine will always be this kind of shadow of the real thing. And so my biggest concern when looking at cryptocurrencies, especially back in 2017, was, okay, so it's open source, anyone can make a copy of it. And so the whole idea of scarcity is then challenged if someone can just make Bitcoin 2 or Bitcoin 3 or Ethereum 2. And so I was like, I was concerned that, even if the space takes off, it's neat technology, the capital could go in and just diffuse among like so many different protocols, like basically a permanent alt season where just like everything kind of goes up and down and nothing really kind of accumulates persistent value. But then I kind of just kept studying the space more, and I saw that the network effects apply very strongly to cryptocurrency. And network effects apply to money in general. I mean, part of why the dollar has hegemony, in addition to just the United States military strength, the history of how we got here, is that it's kind of self-sustaining as a network effect. And so, there's dollar-denominated debt around the world, including in Chile. And so that basically that's demand for dollars, right? Because all these countries need dollars in order to service their dollar-denominated debt. And then out of kind of ease, lenders, when they lend more money, they often do it in dollars. They could do it in euros, sometimes they do, but that dollar has the strongest network effect in that space. And that's why generally diversifying away from it is a slow process, right? Because it's so entrenched already. And so with Bitcoin, for example, or cryptocurrencies in general, the fact that the security is tied to tied to how popular it is generally, right? So it's much harder to attack. That makes it more desirable to begin with, so more people stick with it. That makes it even more secure. We also see, for example, that more developers work on the top cryptocurrencies, so they get better hardware wallets, they get better applications. they get better security and upgrades over time than some of the ones that kind of get left behind. And so we start to see over time that cryptocurrencies start to resemble social networks in the sense that they have these network effects, and you're going to have, most likely just a small number of them rise to the top, and that long tail of thousands of cryptocurrencies, for the most part, don't matter. And so the two that I consider to have really strong network effects this time would be Bitcoin and Ethereum. Whereas the other ones, they might have kind of interesting use cases. They're showing interesting technology, but they still haven't, reached a network effect that is kind of self-sustaining. An example I like to use is, the whole internet runs on TCP/IP, and it could have been, it could have been designed a little bit differently. Someone can make a competing protocol. In fact, there have been competing protocols, but they never catch on because the entire internet's kind of set up to use this one method. And so even if I came along and said, hey, I have this method that's like 5% better than TCP/IP, people would say, oh, we don't care, because the fact that none of the websites in the world are going to interact with your protocol already makes your protocol a million times worse, even if it's 5% more efficient. And so, if anything, TCP/IP could maybe kind of incorporate some of my ideas, make theirs better, but my protocol would never catch on. And so, generally, basically, in order to disrupt an existing network effect, the up-and-comer has to be like 10 times better. It has to be like so much better that you eventually just can't not switch. It's clearly superior. And so we see, for example, that these network effects rise to the top, and then the question is, can they sustain them? Can they upgrade enough to make sure that nothing comes along that's, say, 10 times better, and then they kind of remain kind of the kings of the space?
Where do you see Bitcoin over the next coming years and decades?
So we're starting to see, if you do polls of investors in certain countries, I haven't seen it for the whole world, but I've seen it in individual markets. You're starting to see the fact that as many or more people own cryptos than own gold, and that skews younger. I mean, obviously, if you're in your 30s or 40s or 20s, you're more likely to have that be the case than if you're in your 50s, 60s, or 70s. And so generally, we are seeing an adoption of it as kind of a monetary asset. And so there's some countries like Singapore that's pretty high. And whereas other countries are pretty low, but in countries where it has meaningful adoption, it's generally it's starting to get higher than gold in many cases. Now, so far we don't see that among central banks. They're still buying gold. That's their asset of choice, and that makes sense because even Bitcoin, as big as it is, it peaked at like 1.2 trillion this year so far. Now it's back below a trillion. Ethereum is a few hundred billion, and so. When these markets, and they're very volatile, so when these central banks are looking at it, imagine from their perspective the disaster where they buy Bitcoin and then it's fluctuating around, and then a tail risk happens and it doesn't work out, and then they're like, why did you buy like digits on a computer? What were you thinking? So with like $1 billion, like, so they basically, it's not big enough that they can really kind of put meaningful amounts of funds into it. Now, I do think that if over time Bitcoin continues to grow and kind of has say another kind of cycle of adoption, another big bull market, it becomes a multi-trillion-dollar asset class. If you have that network effect continue to take off, for maybe over 500 million people in the world own it, maybe 1 billion people in the world own it, then it starts to get big enough and maybe a little bit less volatile, and central banks can then start potentially using it as a reserve asset. I don't think they're going to just dump all their gold and just pour into Bitcoin, but they can, especially some of the smaller countries might start saying, hey, we want to have a non-zero allocation to this other type of asset. And especially because not only can they store it as an asset like gold, but they can also use it if they need to as a permissionless payment. They can go around all these international finance channels if they're sanctioned or if other things happen, and they can actually just make payments. And so you actually see, for example, maybe countries like Iran have dabbled in that to some extent because it does offer that kind of technology basis for them. And people might think that's good or bad, but that's just Bitcoin is. And so you could start to see countries maybe hold a little bit of it. But I think overall, it's one of those things where it generally has to get a little bit bigger before most central banks would even really kind of consider it. We see, interesting news out of El Salvador, right? So it's legal tender. And so they're going to have some in their fund. And so that is pretty interesting there. That's kind of a certainly not something I expect to happen in 2021. And so that's actually pretty interesting. And so maybe it's one of those things where I'm saying I don't think a major central bank's going to hold it next 2 years, but who knows? If it gets big enough, you can start to get surprises like that.